Welcome to The Explainer. Today, we're going to do something really cool. We're going to crack open a 68-year-old letter from a young Warren Buffett, and inside, we'll uncover the timeless playbook he used to not only survive, but actually thrive during a pretty nasty bear market.
So, check this out. A full year before the market even started to slide, Buffett sent this stark warning to his partners. He totally saw the writing on the wall. He just felt in his bones that the market was overvalued. And this call, well, it set the stage for one of his earliest masterclasses in investing.
So you have to wonder, right? What exactly was going on back in 1957 that made this 27-year-old investor so cautious when pretty much everyone else was still optimistic?
Okay, so picture this. The market's in what Buffett called a moderate decline. But he noticed something really interesting. Even though prices were dropping, he pointed out that the public was still super bullish. People were acting like the party was still going strong. And to him, that meant one thing. Stocks were still way too expensive.
But here's the thing about Buffett. A pricey, falling market didn't scare him off, not at all. In fact, he saw it as a huge opportunity. And to navigate it, he used this really fascinating two-pronged strategy. He didn't just buy a bunch of stocks and cross his fingers. No, he did something much smarter. He fundamentally divided his investments into two very distinct categories, and each one was designed to protect his partner's capital no matter what the overall market was doing. The first part of his strategy was something he called workouts. You can think of these as special situations. Their success depends on a specific corporate event, like a merger or a sale. So their fate wasn't tied to the crazy whims of the market, which meant they were insulated from all the panic. And then you've got the other side of the coin, his general issues. Now, these were the classic, deeply undervalued stocks that value investors absolutely love. Their success did depend on the market eventually waking up and realizing their true worth. So you see what he did there? It's this brilliant balance. One part of the portfolio was event-driven, and the other was pure classic value.
Now, what's really fascinating here is how he adjusted that balance on the fly. At the end of 1956, his portfolio was about 70% undervalued stocks and 30% workouts. But as the market kept falling in 57, creating what he saw as even better bargains, he leaned in hard, shifting his allocation to about 85% in those undervalued general issues. Okay, so we've seen the strategy, but did it actually work? Let's dive into the results, because this is where the genius of it all becomes crystal clear. How did this 27-year-old's portfolio really do against a falling market? So first, let's just set the baseline. The Dow Jones had a rough year. Even when you include dividends, if you were invested in the average, you lost 8.4% of your money in 1957. Ouch. And most investment funds did about the same, or even worse. And this just shows you the incredible difference. While the market was deep in the red, all three of his partnerships from 1956 were solidly in the green. The first two posted really respectable gains of over 6% and 7%, but then look at that third partnership, an absolutely incredible 25% gain. A 25% gain in a down market? I mean, how is that even possible? Was he using a different strategy? Did he find some secret stock? Well, Buffett's own explanation was surprisingly humble. He basically chalked it up to luck. You see, that third partnership was just started at the perfect time. The market had already dipped, which meant he had fresh cash, dry powder, to put to work in great stocks at fantastic prices. His older partnerships were already pretty much fully invested, so they couldn't take advantage in the same way. It was just the luck of having cash ready at the exact right moment.
But the real lesson from this 1957 letter isn't just about portfolio structure or even getting lucky. No, it's about a much deeper, more profound philosophy that's just as relevant today as it was back then. He told his partners straight up, his strategy was built to shine when times were tough. He knew his intense focus on value and these special workout situations would provide a kind of buffer that all those high-flying bull market investors just didn't have. It's the ultimate contrarian mindset. And this, right here, is the crucial point. This is the whole game. While most investors are freaking out when prices fall, Buffett was welcoming it. He saw a declining market not as a threat, but as a golden opportunity, a buyer's market where he could scoop up great assets for way less than they were actually worth.
You can see how this all builds into his core process. It's incredibly simple, but it requires just immense discipline. First, find those undervalued companies. Second, buy them slowly, patiently. And third, you just wait. You wait for that value to be recognized by everyone else.
And there it is. That's the line that just sums it all up. For Warren Buffett, patience wasn't just some nice-to-have virtue. It was an active, profit-maximizing strategy. He understood that the real money isn't made in the frantic buying or selling, but in the waiting. You can totally see how this early experience planted the seeds for his entire modern philosophy. Which leaves us with a really powerful question for today. In our world of instant trades, of 24/7 financial news, and endless noise, is this 68-year-old lesson, the simple, disciplined act of being patient, still the one true, timeless advantage an investor can possibly have?